Hey there, and welcome to this explainer. Think of our time today as a one-on-one strategy session. Just you and me. Together, we're going to build a resilient, unshakable playbook for your portfolio. Whether you're literally just starting to take control of your financial future, or maybe you're looking to solidify what you've already built over the years, my absolute goal today is to give you a really clear, structured understanding of how to navigate risk and fortify your wealth. Okay, let's dive right into this.
So, I want to start off by asking you a very direct question. It's one that every single investor eventually has to confront. How much of your hard-earned wealth do you actually want to risk in volatile paper markets or just sitting in cash? It's a serious consideration, right? We live in incredibly uncertain times, and simply holding on to cash or just riding the roller coaster of the stock market, well, it can leave you totally exposed. We need to figure out exactly how to protect what's yours, and to do that, we need a really reliable map.
The map we're going to use is called Exter's Liquidity Pyramid. It was created by the renowned economist John Exter. Now, don't worry, this isn't just some abstract, boring academic concept. This is a highly practical tool that ranks asset classes based entirely on their liquidity, which basically means how easily they can be bought or sold, and their level of risk. It's really the foundational playbook for understanding where your money actually sits within the grand scheme of the entire global financial system. Let's walk through it from the ground up. At the very bottom, the rock-solid foundation of the pyramid, we have the most liquid and absolutely least risky asset, physical gold. Moving up just one layer, we find Federal Reserve notes and Treasury bills. Now, these are very liquid, sure, but they carry risks like inflation or suddenly shifting government policies. The middle layers, that's where you'll find your blue-chip stocks, corporate bonds, and sovereign government bonds. Moving further up into private business equity, real estate, and non-monetary commodities. These are productive assets, yes, but they're definitely less liquid, they carry a lot more risk, and they are highly sensitive to economic cycles. Finally, right up at the very top, we have the least liquid and the absolute riskiest assets, derivatives and unfunded government liabilities.
You have to notice the stark contrast here between the base and the top. Physical gold is tangible. You can hold it. It offers incredibly high liquidity during a crisis, and most importantly, it has zero counterparty risk. That means its value doesn't rely on some third party keeping a promise or fulfilling a contract. On the flip side, the top of the pyramid is dominated by those derivatives. These are incredibly complex financial instruments dripping with high counterparty risk. They are volatile, they completely lack transparency, and frankly, they're usually the very first assets to just completely lose their value and become totally illiquid the second an economic crisis hits.
So, the absolutely crucial point here is understanding what happens when panic sets in. I want you to think of capital like water. When an economic storm hits, water always seeks the lowest, safest ground. In the financial world, we call this the flight to quality. Capital rapidly flows down the pyramid. It totally drains out of those risky, complex layers at the top and just floods into the safer, more liquid assets at the base, like gold. And this massive downward rush actually drives up the value of those foundational assets right exactly when you need them the most.
I really want you to internalize why the source material positions physical gold as this ultimate, unshakable foundation. I mean, it's not just a shiny rock. Think about this. An ounce of gold bought a fine suit of clothes way back in ancient Rome, and guess what? It still buys a fine suit today. It is a tangible asset that has been universally valued for literally thousands of years. We already talked about the absolute beauty of zero counterparty risk. Nobody has to make good on a promise for your gold to actually be worth something. Because of its scarcity and its intrinsic value, it acts as a remarkably reliable store of wealth. And critically, as inflation just eats away at the purchasing power of paper money, gold has historically maintained its value. When everyday prices go up, the value of gold typically goes right up along with them. It's an incredibly powerful historical hedge.
Section 1. Current market trends. The why now.
Now, if you're looking around at the state of the world right now and feeling a bit anxious, well, your feelings are totally validated by the specific global factors driving smart money straight towards safe haven assets today. First off, we've got geopolitical instability. Ongoing conflicts, specifically in Eastern Europe and the Middle East, are causing sudden, massive spikes in gold prices because investors are scrambling to protect their wealth. Second, rising global inflation concerns have people practically desperate for assets that actually preserve their purchasing power. Third, and guys, this one is massive. Central banks all over the world, notably in China and Russia, are aggressively surging their own demand for gold so they can diversify away from the US dollar. Oh, and alongside all of this, silver is also experiencing some truly significant gains. Gold is surging and hitting wild new all-time highs in 2024 because of these exact undeniable drivers.
$3,000 an ounce. Let that sink in. That is the bold prediction coming straight from major financial institutions like Bank of America and Goldman Sachs. Driven by the exact instability, inflation, and massive central bank demand we literally just discussed, they are predicting that gold could reach $3,000 an ounce within the next 6 to 18 months. So yeah, the bullish outlook right now is incredibly strong.
Section 2. The game plan. Your portfolio allocation.
All right, for a new investor, you need a clear target. A great starting point is to aim for a traditional mix. Let's say 85% sitting in your middle pyramid stocks and bonds, 5% in cash for that immediate everyday liquidity, and then a dedicated 10% carved out just for gold. In fact, financial experts frequently recommend allocating between 5% to 10% of your total portfolio to gold. Doing this ensures you have a rock-solid structural base that can actually catch you when those upper layers of the pyramid start shaking.
But of course, every playbook has to be tailored to the actual player, right? So how do you adjust that 5 to 10% sweet spot? Well, first, you really need to assess your personal risk tolerance. If you're highly risk-averse, if you lose sleep over wild market volatility, you might want to lean towards a slightly higher allocation in gold just to buy yourself that peace of mind. Second, define your long-term investment goals. If your primary goal right now is purely wealth preservation and protecting against inflation, gold suddenly becomes a much more critical component. And finally, evaluate that incredibly bullish market outlook we just went over. If the trend is pointing sharply upward, a slightly higher allocation might be entirely justified for your specific personal situation.
I want to leave you with this really powerful, direct quote from our source material, mostly because it just perfectly encapsulates the proactive mindset of a successful investor. Here it is. Don't wait until it becomes hard to source at any cost. Fortify your wealth with gold and silver today. By understanding Exter's liquidity pyramid, you now realize that when the flight to quality happens, literally everyone rushes for the exact same exits at the exact same time. You want to have your foundation fully built before the storm hits, not while you're already standing outside in the pouring rain.
So as we officially wrap up this explainer, I want to leave you with one final, vital question to really chew on. Is your financial future fortified? You've got the map now. You understand the hidden risks lurking in the upper pyramid, and you see the massive macroeconomic drivers pushing all that smart money straight toward the base. Now, it is totally up to you to take ownership of your portfolio and build a foundation that actually lasts. Thank you so much for joining me for this strategy session.